you are still looking at gains across the board. All three of the major averages opening to the upside. Now, the market looking to rebound from its worst week of the year. So here with more, we want to bring in Brad McMillan. He's Commonwealth Financial Network Chief Investment Officer. Brad, it's great to have you here. So let's talk about the biggest factors that are driving the market right now. We had the hotter than expected or better than expected retail sales print out this morning. Earnings actually looked pretty good out this morning from Goldman Sachs. But then, of course, you have the geopolitical risk, the rising tensions going on right now in the Middle East. How are you evaluating this from a strategist standpoint?
Well, Shauna, when you look at what's going on, it's easy to get caught up in the details, but I think we need to focus on two things. First of all is valuations. We've seen interest rates spike a bit, and that's not unexpected, but the market is largely getting its head around. And we saw a couple of bad days, but the valuations are kind of stable where they are. So that means it all comes down to earnings, and that essentially means domestic demand. So I'm keeping an eye, as I have been for a year and a half now, on job growth, on consumer confidence, and the international risks. They're real, but they're always there. So I'm not too concerned about them in the short to medium term.
Brad, you're one of the second major guests that we've had on to say demand is one of the larger themes to listen for this earnings season. Where do you believe that may moderate, or what are the key words that investors should zero in on when they listen into any commentary around demand, either in the press release or in the earnings call that takes place thereafter?
I think it's about the consumer. I mean, what we've been talking about consumer concerns. And for example, we saw the Michigan Consumer Sentiment Survey pull back a little bit. Now, it's still healthy. It's still up from where it was several months ago. But I think the real question going forward for every company is going to be, how are they doing with the consumer? What are they seeing the consumer buying? And I think that's really what's going to determine where earnings go for this year.
Brad, how do you think the Fed is looking at the recent developments here? Because, again, you have another econ data point that's out showing that consumers are still out there spending, even in the face of uncertainty. And then you have the risk that we could see energy prices move to the upside if the tensions in the Middle East were to escalate. So what does that mean for the likelihood of the timing of the first rate cut and how many cuts we will likely see before year end?
Well, Sean, I've been saying this for a long time. I think people are asking the wrong question. People are saying, when's the first rate cut? How many rate cuts will there be? I think the right question is, why on earth would the Fed cut rates? Inflation is still high, job growth, and remember, those are the two statutory priorities. Job growth is still strong, so there's no reason from the Fed's perspective to cut rates. Not only that, when you look at it from a going forward perspective, the more seriously you take the risks, the more you have to say, okay, the Fed is going to hold off on cutting so they can keep their powder dry until they really need it. And they don't really need it right now.
And so where would the biggest shift take place? And whether or not we see rate cuts commence this year or beginning of next year, even, as some economists are wildly revising the 6 and 7 cuts that they had priced in coming into the start of this year. What does that tell you about the time span and the duration of the cuts that we could be looking at once they finally do commence?
I don't think we're going to see any rate cuts this year. I wouldn't be surprised if we didn't see any next year. I think there's a real chance. I'm never going to say it's different this time. I've been burned by that before. But when you look at the underlying dynamics of the labor market, I don't see a reason to see the significant pullback in employment that we've seen. And I also don't see a reason why inflation is going to go back down. So as long as employment stays strong, I would say not this year, probably not next year, unless we see a significant pullback. We see a significant collapse in job growth. And that just doesn't seem to be in the cards right now.
So, Brad, if we don't get a rate cut this year, if we don't even get one in 2025, what does that then mean for equity action, just in terms of how investors should be positioned, where you think makes the most sense, given the fact that there's so much unknown at this point?
Well, the thing is, when you look at where return streams are coming from, we've seen most equity returns coming from multiple expansion over the past, several years. We've seen multiple expansion driving it up. Earnings have done okay, but that's not where the juice has been. So we're probably going to see valuations stabilize, but that means we're not going to get the boost from valuations going up. So you have to look at earnings growth. And one of the things that has kept the Magnificent Seven running is that they have had both the valuation expansion and the earnings growth. Now, maybe that's starting to change. You look at Tesla, you were looking at Apple, you were just talking about that before the break. That's something where all of a sudden you're not going to have that tailwind. It's going to be a lot more about earnings. And that means we're going to see a lot more vulnerability. At the same time, when you look at stocks like value stocks, typically, or consumer staples driven stocks that are really driven by the US domestic economy and can respond to that growth with better earnings, that's a better place to be.
All right, Brad McMillan, always great to get your perspective here. Thanks so much for hopping on with us this morning. Commonwealth Financial Network's Chief Investment Officer. Thanks, Brad.